Last month, I was on Twitter following ICT, of course, the man himself, the ghost behind the machine. And in his tweet, he had a post about market making, and the tweet read as follows: If a market maker, not a dealer, was going to operate in the delivery of any market, number one, they would operate in a specified and designated time each day. Number two, they would engineer false evidence for the speculators to doubt or trust a particular price anomaly. Number three, they would use tactics over and over while the general public never recognizes it. Number four, they would victimize the profitable for the express purpose of unseating them. Number five, they would operate under false narratives that a dealer is a market maker when they aren't. 6, they would allow you to believe you understand something that you don't. 7, they would deliver price in a manner to allow smart money entities to make the lion's portion everyday trading. I love the number 7. Well, step index on a daily time frame. We are going to go over some market making principles in this video, and this one, it also is about time, specifically the midweek. So we have to understand where price has come from in respect to the daily time frame. As you can see, since the opening of June, price action had been one directional bearish up until price action reached a key support in the marketplace. Support is the 20th of February 2025 fair value gap. I had previously annotated, so let me annotate it again for those that are new. This is the fair value gap that I'm talking about, and each 20th in every new month, this particular 20th right here, it provides volatility injections to attack liquidity that is resting above the marketplace or below the marketplace. So we have been supporting in this fair value gap in here, and in here again in June. All right. So in my previous video, time and price analogy, stating how this liquidity pool, along with the 20th fair value gap of February, how it was going to be used as a liquidity to be attacked. So if we know that price wants to go down here, what are the forms of confluences that we may use for price action to want to come down below this particular support? Well, number one on the list is this particular fair value gap, the new weak fair value gap. It displaces lower, and what I teach about the new week is that it tends to provide volatility injections that are very quick, one directional, okay? And it usually prints a huge imbalance or a fair value gap inefficiency. It prints that in the marketplace. Now, retail traders, a lot of them, they are seeing this Monday's candlestick as a means of a shorting opportunity. If price opens and trades up into that level, they treat that as a key level, a key resistance. They want to chase move going to the side. Well, here is midweek. What does it do? It trades inside of the fair value gap. Now, in smart money concepts, we don't chase price action as it is going lower. We don't do that. We wait. we wait for price action to come inside of that price inefficiency. While other retail traders, what are they doing? They're looking at this particular key level and treating it as a resistance. If it is broken, they're going to treat it as what? As a support. While they're looking at this particular level as a support, we on the market, we are analyzing for price action to want to come down here. So there's a lot of factors in terms of market making in this particular fair value gap. We are always looking to attack liquidity. Where is liquidity? We have the internal range liquidity. Internal range meaning that from this particular range high, by the way, nice fair value gap respected here as a resistance. I spoke about this as a resistance before this new week had begun. I stated how it would use this particular fair value gap as a means of going lower. So this internal range liquidity is a low in between this high and this particular low. Where is the external range liquidity? In here, this is the external range liquidity, and this high as well, it is external range liquidity. So in your dealing range, what do we have? We have a premium market. Once we trade inside of our premium fair value gap, we anticipate price action going lower. All right. What other forms of confluences that we may use? Well, let's go over to lower time frames. So here is the 4-hour time frame, and right off the bat, we see this particular fair value gap, and let me annotate it. Why is he picking that fair value gap specifically? Well, it is situated at the fair value gap high. I'm not just picking any random fair value gap. I am choosing this particular fair value gap. Why not this one? Well, this one does not have any key level to key off of from the higher time frames. This one has a key level from the daily time frame, the fair value gap high. I have the consequent encroachment of this particular fair value gap, and you can see how it is being respected beautifully. So this respect of the consequent encroachment, well, what is it saying about order flow when we respect the 50%, which is the consequent encroachment? It means that price is bearish. We are still following through with a bearish bias, good people. When other retail traders are looking at this key level as a support to go long, we are looking at this particular key level as a target, as a means of a target. You see this low, it is close to this one. What is this? This is relative equal lows. This one as well, it is pretty close to this one. So what is this? Relative equal lows. And this particular fair value gap, it is unmitigated. This is where we want to go. Good folks, this is where we want to go. We have respected our 4-hour fair value gap. I spoke about this one. And look at the respect on this one as well. The new week fair value gap now transposed into a smaller time frame fair value gap. I love the respect on this particular fair value gap. Let's drop over to the 15 minutes. So step index on a 15 minutes time frame. Now we're going to talk about market making for a little bit. If you do recognize the market maker models coined by ICT in this chart, well done. We have the key level here, new week fair value gap high, and the consolidation of Monday and Tuesday. I treat this as our original consolidation, and this is the accumulation going long into our 4-hour fair value gap, our key level from the 4-hour time frame, and I have the consequent enroachment of this fair value gap on the 4-hour, and I have this block on the 15 minutes time frame. I have entered beautiful shorts on the 15 minutes time frame, and I have my stop just above this key level consequent encroachment. All right, I am aiming for the obvious Tuesday and Monday, which is a consolidation. So I'm fading all of this liquidity going up. I am basically fading all of that. I am selling short at a higher time frame in respective to the 4 hours. This would be a higher time frame key level of the 4-hour time frame. Now, if I split the new week fair value gap high to low, I am essentially selling at a key level from the daily time frame, the upper quadrant of the fair value gap itself. I love the respect on the 50%. That is liquidity 101. Look at the relative equal lows in here. These are clean and concise. They tell you where the liquidity is at the 50% of the range high to low of the new week fair value gap. So we are essentially selling above the 50%. Price has failed to take out this particular rejection block or even trade to the last up close candlestick right here, as it has supported on the 50%. It should have traded just to take the closing price of this up candlestick. We would treat that as a rejection block. Okay, but it has not traded up into the rejection block itself. So what does that tell you about order flow? It has not traded up in there. So what was price doing as it was going up? It was coming up to attack the liquidity pools in here and in here, just to offset the liquidity pools in here. So we have grabbed the liquidity pools in here, and if we drop down into a lower time frames, we will see that we have a 5-minute fair value gap from this high to this low. 5-minute time frame fair value gap is here, and I have a lot of confluences with the 15 minutes time frame bearish order block, the 75% upper quadrant, and I have a breakaway gap. I treat this as a breakaway gap. I don't want to see price action trading up in here. So I have entered my shorts in here, and I have placed my stop loss somewhere in this wick. So with this one, I leave you to backtest this information. I will see you in the next video.